With Rise48, the way we kind of select which markets to go into, it's really based on job growth and population growth. The purpose of expansion is to help investors diversify where they're investing. We don't want 50 assets all in one location. We want to help investors diversify their holdings across the entire Sun Belt. We started out in Phoenix as our main market and expanded out to Dallas and North Carolina, and we're kind of expanding more in the Sun Belt area. The reason we focus on the Sun Belt is because it has the highest job growth, highest population growth. The other factor that kind of plays into it is how landlord friendly is that state. As you're going into a market, if it's very cost prohibitive to invest in that area and help investors get profits, it just doesn't make economic sense for us to get into it. We always want to make sure that we're targeting markets where we know there's future growth, as well as markets where it makes sense to invest and grow the overall pool of investments. So whenever we get into a new market, the market as a whole may be a very big market. Like DFW is one of the biggest markets in the nation. What you want to start focusing on is the submarkets where you're going to buy a property. So we're going to buy, 200 to 300 unit asset. If it's part of South Dallas or downtown Dallas, the investment strategy changes. We only do value add plans. We don't do core plus. So buying a value add asset in the middle of downtown may not make much sense, but buying a core plus asset may make all the sense. When we get into the submarket, the next step is, hey, we're going to walk the area, check out, which areas to be in, not in. And then from a corporate side, we'll start looking for regional directors in that area who are familiar with that specific market, so that when we do get a deal under contract, we know we're not buying in the bad part of town, for instance. We have good insight and good experience in that area, so we can execute our plan without major hurdles we may face if we just went in blind. With population growth, it's one of the biggest factors that we look at. We want to make sure that we're going where people are moving. We're in the apartment business and in the shelter business. So if people are moving out of the state, my pool of supply is dwindling. And if your pool of supply is dwindling, that means you're going to get lower returns effectively on your investment. So we want to target our areas where, there's heavy demand for apartments, for housing, so that when we do go into that area and we're investing significant amount of capital in improving these assets, that we're going to see a return on it. In order to make sure we're not getting into a market where it's just going to be very supply heavy for the foreseeable future, we'll look at CoStar data, we'll look at RealPage data, other reports that we see from these big brokers like Newmark, CBRE. They put out quarterly data on how the supply and the demand is looking at every single market. Obviously, with very high demand, you're going to see that supply get absorbed faster than you see it in low demand areas. So we're not just looking at what does the current state look like, we're looking at what does the next 4 or 5 years look like. So if a market is very heavily supplied today, but there's significant demand and you're seeing that supply drop off a cliff in the next 2-3 years, it might make sense to invest today. You might see some negative rent growth for the next couple of years, but then you might see a significant upshoot once all that supply is absorbed, because it takes 2-3 years to build. So Charlotte's a great example. We expanded out there in 2024, and we knew going in 2024 and 2025 there's going to be a lot of supply going out there. So we didn't underwrite to assume 10% rent growth out of the gates. We assumed, hey, we're going to go ahead and get a nice foothold in the area, buy quality assets, and then as that supply dissipates and the demand stays consistent, we can exit these deals in 5-6 years with a better than expected outcome, assuming that demand doesn't fall off a cliff with the supply. From an operating expense or the underwriting perspective for these markets, they're actually very similar on the controllable side. So payroll, marketing, G&A, maintenance expense, turnover expense. I would say from market to market, you're not seeing a significant change. And it's primarily because we're in the United States and in the Sun Belt. We're not going into Minnesota, for instance, where you have to now start covering for snow removal. All of the locations that we're in, they're generally similar. Now that's on the controllable side. On the uncontrollable expenses, which is primarily the utilities, property taxes, insurance, those vary significantly by market. Utilities, maybe not so much, but from a property taxes, for instance, in DFW, significantly different than Charlotte or from Phoenix. So we have to watch out for those items. And on the insurance side, that we have to be careful on as well, because different markets have different insurance premiums. DFW, for instance, our insurance premiums may be close to $1,000 a unit, whereas in Phoenix, it might be close to $400 a unit. So from that perspective, we have to be careful, but we build that into our model to make sure we're not underwriting utilizing Phoenix metrics for DFW or vice versa. We're always cognizant of that, but that's one of the things you have to just watch out for on the uncontrollable side. think a good market, it has a mix of what we see in Phoenix, DFW, and North Carolina. So Phoenix, for instance, our non-controllable expenses are great. Property taxes are a limit to 5% increase every single year, regardless of a capital transaction. So that helps a lot with the underwriting. It takes a lot of the risk away from the revaluations. DFW has a great tenant base, quote unquote. So, getting those types of tenants, it's great because you can get good premiums for all the value add that you do. And from North Carolina perspective, similarly, tenants are a lot better there than what we kind of see in Phoenix. Even there, the insurance expense is very limited. You see a good growth opportunity there as well. So you're seeing Charlotte climb the ranks for population growth year over year. A lot of jobs are moving there. So seeing a blend of that into a market is great to kind of aim for.